Evening and welcome to India Ratings webinar to discuss Adani Transmission's IND AA Plus rating. Divya Cherin, analyst from the Infrastructure Group, would be taking you through the presentation, which will cover the key rating drivers and sensitivities of the rating for the next 15 minutes, and we would be open to questions post that. You can type in your questions at the webinar control panel. Alternatively, you can email your questions to us at investor.services@indiaratings.co.in. The press release of the report is attached as a handout for your reference. With this, I'll hand over this webinar to Divya. Over to you, Divya.
Thank you, Archana. Greetings, everyone. Adani Transmission Limited is a holding company for transmission assets in Adani Group. ATL is a listed company. ATL has recently raised debt of about 8,300 crores in obligor group structure. Under this structure, Adani Transmission owns two operating subsidiaries, ATIL and MEGPTCL. ATIL and MEGPTCL are together called as obligor group. So one unique thing about this transaction is, though the debt is raised at the parent company level, which is ATL, the entire ATIL and MEGPTCL are ring-fenced for servicing this debt. So the waterfall mechanism is present in ATIL, MEGPTCL and ATL to service the debt which is raised at ATL. The majority of the debt raised at ATL has been used to refinance or pay out the debt at ATIL and MEGPTCL. Refinance or pay out all external debt at ATIL and MEGPTCL level. Now we will go through the strength key rating drivers of this transaction. So ATIL and MEGPTCL own only operational assets, and all the assets are on a return on equity based tariff structure. So they have a high revenue visibility, and their revenue is based on the availability targets that they have to meet. AC systems have to meet the availability target of 98% and DC target of 95%. As we know, the transmission assets all over India are comfortably maintaining availability of 98%, including PGCIL and all the private transmission assets as well. The cost volatility is low, and the proportion of cost to overall revenue is just about 8 to 10% at max. So the effect of cost volatility is also low if there is even volatility. The regulation remains supportive and consistent, and even with the recent changeover of regulation at CRC level in 2014, there is not much impact on the transmission assets. The refinancing risk for this transaction remains low. There is some refinancing concentration in next from FY 19 to 22 period, but that can be reasonably managed given the long life of the assets. The counterparty, there is some concentration risk in counterparty because Maharashtra contributes to around 60% of the revenue of the obligor group right now, Maharashtra-based counterparties. However, transmission assets being a monopolistic asset for which a replacement cannot be found, we feel that the counterparty risk is also partially mitigated, but that said, some concentration risk remains. So moving on to the predictable revenue realization, this obligor group continues to enjoy a good payment cycle. The payment days for interstate assets, that is Mundra, Degam and Mohindargarh asset under ATIL, that enjoys a payment days of less than 60, and the Maharashtra based assets, that is Tiroda Varora and Tiroda Aurangabad, they enjoy a payment days of less than 30. And cost approval wise and tariff approval wise, Mundra, Degam, Mohindargarh MDM assets have got 96.5% of their project cost approved, and also arrears of 230 crores approved. This 230 crores will be received on a cash basis in FY17, and in Tiroda Varora the tariff has been approved for FY 17 to 19. Again, in Tiroda, Aurangabad, the tariff has been approved for FY 17 to 19, along with approval of arrears of 560 crores. Out of this 560 crores, which may be entirely booked this year on cash, however, the cash received in the current year is estimated at 370 crores out of 560 in current year, and balance 190 crore will be received in the next year, FY 18. There are some part of the tariff which was project cost which was disallowed in MEG-PTCL, that is Tiroda Aurangabad asset. About 8% of the project cost was disallowed, provisionally disallowed. So MARC will review the documents again on those disallowed components and come up with a tariff order and their final decision on that component. So that is a major tariff order which we are looking forward to. Again, there is a the tariff order for FY 15 to 19 for MDM assets is also pending. These two orders are major petitions which we will keep track on for the future. The operations are stable. As we can see, all the assets are reporting an average availability of above 98%. So overall, the cash flow for current year is going to be excellent, in the sense there are a lot of arrears going to be approved for the company. The company has already completed the acquisition of Aravali Transmission and Maru Transmission from GMR Energy Limited. These are intrastate assets where the counterparty is Rajasthan-based utilities. But these two companies are very small in the overall scheme of things, in that they contribute a EBITDA of 58 crores out of ATL's present EBITDA of about 2,000 crores. So Aravali and Maru are two very small assets, and the overall investment from ATL for those two assets is about 100 crores. So that is the investment put in for these two companies. For the proposed acquisition of three assets from Reliance Infrastructure Limited, the overall investment is estimated at 550 crores. So the overall acquisition expenses is 650 crores in FY 17 and spread over FY 17 and 18. And the under construction assets, which are 5 assets listed on the right side of the presentation, they require an investment of around 700 crores in the next 3 years. The residual cash flow position at 650 to 750 crore annually for the next, from FY 17 to 19, provides a great comfort, and that will be sufficient to meet these acquisition expenses and also equity requirement for the under construction assets. As I said, the last year the EBITDA was 19 billion, and in FY 17, because of the arrears and improved tariff realization, the EBITDA is going to be around 21.6 billion, and the cash flow for debt servicing is will remain very comfortable. For the interest expense will be around 8 to 8.5 billion, and the repayment of around 4 billion. So the excess cash with the company will be like 7 to 7.5 billion for the current year. So the refinancing, as I said, it's bunched in somewhat bunched in FY 20 to 22. Around 1,000 to 1,200 crores of refinancing may be required in those 3 years. But given the long life of the asset, we remain optimistic about their refinancing capability, and their diversification of the sources of funds also remains a positive factor in that. Of course, the refinancing requirement in FY 26 is a bit high at 33.5 billion. However, we hope that that could be addressed with before the maturity comes at that point. So the rating sensitivities are adverse regulatory action, high concentration risk of refinancing in any particular year, and the debt amortization pattern significantly deviating from the regulatory depreciation. Since this project follows will get tariff based on regulations, in which the depreciation falls off in by the first 12 years. The depreciation is high in the 12 years, so they will get high tariff in the first 12 years. We will also monitor that they also pay the debt equivalent to the depreciation in the first 12 years, so that the burden does not remain for the end of the asset life. And the other factors, the coverages and the metrics, will also be monitored by India Ratings. That's all from my side, Archana.
Thanks, Divya. We will now begin the Q&A session. Participants are requested to type in their questions at the webinar control panel or email us at investor.services@indiaratings.co.in. Divya, the first question is from Nikhil, and the question is, after taking all the acquisitions into account, what is the revenue dependence on Maharashtra and other states?
The revenues dependence on Maharashtra will decrease to about 55 to 60% after the acquisitions. And I mean, now the dependence is between 60 to 60, around 60 to 65%. It will decrease a bit. It will go below 60% now.
Okay. The next question is from Ashish, and the question is, please discuss the implication on recent asset purchases on the rating and outlook as the company remains on high capex mode.
We feel recent acquisitions and even including the investment requirement for the new projects, these actions are rating neutral, because the residual cash after meeting the debt service is right now sufficient for the company to meet all the investment requirements. And it should also be noted that the waterfall mechanism requires that only the cash after meeting the operational expenses, debt servicing, reserve requirements of the senior debt in ATL, will the cash be allowed to go for any distribution, including for the investment in new assets. So there is always protection for the debt at ATL level. So and ATL is also restricted from raising any new debt apart from the already allowed limits under the rating. So ATL has limited room for any additional leverage. Considering all these factors, the investment planned right now are unlikely to affect the outlook or the.
Next question is from Akshay. The question is, how much additional debt can company take to sustain its AA plus rating, considering the same profitability and cash flow levels?
Right. Considering the current profitability and cash flow levels, the debt limit of 8,500 crore for FY17 is already frozen, and we don't foresee additional debt at current level at the current cash flow levels. Possibly, if there is a favorable petition, there are some of petitions, especially for Mundra Degam Mohindargarh asset. There is a petition for allowing the interest rate based on rupee term loan rather than the earlier external commercial borrowing. So that can result in a huge increase, not huge, substantial increase in revenue for the company. But even then, but the additional debt, if any proposed, will be assessed at that time. at all. Right now, without any new developments, the limit is already reached, and there is no additional scope for borrowing in ATL.
Divya, the next question is a follow-up question from Nikhil, and the question is, how is the company funding our infra acquisition? How much of debt will come in?
The company is, as I already explained, the company is funding the acquisitions through internal accruals, which are sufficient for the same. And the additional debt which is going to come into this company is around 1,200 crores. Not come into this ATL directly, come into the acquired subsidiaries is around 1,200 crores. And the overall debt to 1,200 crores against a EBITDA for these three assets, which will be around 310 crores.
Okay. Divya, Ashish Bali quickly wants you to elaborate on the areas piece.
So the areas approved for MEGPTCL is 570 crores for the current year, of which approved is 570 crores. The company may book the entire revenue this year, but the cash realization in the current year will be around 370 crores. So the balance 200 crores will be realized in next year, FY18. Of the 230 crores of arrear approved for MDM, Mundra Degam and Mohindergarh asset, the entire amount will be realized in the current year, FY17.
Okay. On the areas bit, there's one more question from Nikhil. And the question is, can you please clearly lay out how much areas will be booked in FY17 and how much in FY18?
Yeah, I think I just addressed that question as part of the previous question.
Okay, there's nothing more to add.
Yeah.
Okay. There's another interesting question from Vikas, and the question is, how ring-fenced is the obligor group concept? Does it mean that any debt raised outside the obligor group could have a different rating?
Under the structure, there is no scope for ATL to raise any debt out of the structure. Any debt raised by ATL has to come into the structure, and that is possible only after two rating agencies affirm the rating, even after considering the additional debt that ATL may propose. So there is no possibility of ATL borrowing outside the obligor structure right now. For any new company which can, for example, one of these operational, few of these operational subsidiaries may be proposed to come into this obligor structure, even then two rating agencies have to affirm the rating after considering that proposal. Also, all the covenants, including the debt to EBITDA or DSCR, FACR, all those covenants will also be looked at, and they should not be breached if when these companies come into the obligor group. So that's how the additional debt part works. When we come to the overall obligor structure, the obligor structure ensures that all revenue from ATIL and MEGPTCL is funneled to ATL for servicing ATL's debt right now. So this, whatever the limit, that 8,500 crore limit, of which currently they have outstanding of around 8,200 to 300 crores, this amount is pertaining to the debt of ATIL and MEGPTCL. So ATL will get revenue as interest repayment and principal repayment for the debt it has on lent from ATL to ATIL and MEGPTCL, and also the dividends will also go to ATL. So the entire cash flow from ATL and MEGPTCL will go to ATL, and ATL has to first utilize it for operating expenses, then for interest debt servicing, and then after meeting the financial covenants for distribution, they can take it out for investment in any new company for equity infusion in their under construction companies. So the obligor group ensures at all point of time the cash flow is prioritized for debt servicing.
Thanks, Divya. The next question is, how will the consolidated debt and EBITDA change after acquisition?
Well, the current debt to EBITDA is at about 4.2, and the debt to EBITDA for all the five Maru, Aravalli, and acquired from GMR Energy, and the three assets of Reliance, of the debt to EBITDA of all the five assets are 3.8. So altogether it works out to 4 after acquisition. Currently it is at 4.2. It will come down to 4 after acquisition.
Okay. And the last question is there any scope of further acquisition?
Cannot be entirely ruled out. Maybe in late FY 18 or 19 it cannot be ruled out. But any further cash flow commitments right away in next 12 months is unlikely. I mean the scope for that is very less. But once the cash flow from all these operational assets are also accrued to the company may find some scope for small acquisitions. But basically it will be tight in the next 12 months.
Thank you, Divya, for the presentation and the Q&A session. We will now close this webinar for the day. Thank you, participants, for joining us. Please feel free to send us your queries and feedback at investor.services@indiaratings.co.in. Thank you very much.
Thank you, everyone.